How to invest in bonds for beginners. Most investment channels, myself included, talk a lot about stocks, so it might actually surprise you to know that the bond market is much bigger than the stock market. In fact, if you don't have bonds, you may be missing out on a key asset that can help reduce your risk while improving your long-term returns. This video is designed to help answer all your questions on bonds and to help you decide on what type of bonds might be best for you. We'll discuss what are bonds, how do they work, the components of a bond, the risks involved with bonds, who issues these bonds and the different types of each. And if you stick around to the end of the video, we'll be walking through exactly some of the investment options that you can use to invest in bonds. Let's get started. Whether you realize it or not, you've likely dealt with bonds in one form or another already. Hey man, can I borrow 10 bucks? I left my wallet at home. Yeah, I guess I can get you. You can pay me back though, right? Yeah, I got you. I'll pay you back. Like your friend, corporations and governments sometimes need extra cash, and they'll issue bonds hoping to get a loan from investors. Now, unlike the informal agreement with your friend, these bonds are very specific. When companies or other entities need to raise money for new investments, maintain their current ongoing operations, or just refinance debts, they may decide to issue bonds directly to investors instead of getting a loan from a bank. The issuer of the bond contractually states what interest will be paid and at what date the initial amount of money or the principal that you loaned them will need to be returned. For bonds, the interest rate has a special name called the coupon rate, which dates back to when bonds had actual coupons that you'd rip off them in exchange for your interest payment. Let's go over some definitions. Most bonds share some common characteristics. Face value is the money amount the bond will be worth at its maturity, and it's also the reference amount the bond issuer uses when calculating interest payments. So for example, say an investor purchases a bond at a premium of $1,090 and another purchased the exact same bond at a discount of $980. When the bond matures, both investors will receive the $1,000 face value of the bond. Just so this is clear, at maturity date, the bond will be worth $1,000. But before that time, the bond might be trading in the market above or below face value of $1,000. So buying below that face value is called buying at a discount, and buying above that face value is called buying a premium. The coupon rate is the rate of interest the bond issuer will pay on the face value of the bond expressed as a percentage. So for example, a 5% coupon rate means that bondholders will receive 5% times 1,000 or $50 every year. Coupon dates are the dates on which the bond issuer will make those interest payments. Typical intervals are annual or semi-annual coupon payments. Maturity date is the date on which the bond will mature, and the bond issuer will pay the bondholder the face value of the bond. The issue price is the price at which the bond issuer originally sells the bonds. Most of the time, the issue price is at face value. There are two characteristics of a bond that are the main determinants of a bond's risk: credit quality and duration. Credit quality is a measure of how likely the bondholder will be to repay the bond in full. Duration is the length of time between now and the maturity date when the bond will be paid back. Companies with a poorer credit rating and have a higher risk of default generally see their bonds trade at a discount because there's more risk as to whether the bondholders will actually get their full money back at maturity. High quality companies or government bonds, which have a very high likelihood of being paid back in full, tend to have lower interest rates than these more risky bonds. As for duration, bond maturities can vary from as short as a single day to as long as over 30 years. The longer the bond maturity or duration, the greater chance is that you'll see adverse effects. This is why longer duration bonds tend to have higher interest rates than shorter duration bonds. Another key risk that bondholders particularly need to be aware of is inflation. Inflation is the mortal enemy of bondholders because it directly eats into the real value of the coupon interest payments that you're receiving. If a bond has a coupon rate of 5% and you bought it at par, or meaning at face value, then you're getting a 5% nominal return. If inflation is 3% per year, that 5% return is really just a 2% real return. If inflation rises to 5% per year, you've effectively wiped out all of your interest gains from the bond. Predicting inflation rates is very difficult to do, and it's one of the reasons why there's more risk involved with longer duration bonds. As I've mentioned earlier, bonds can be issued both by companies and the government, but there's some differences between each. Bonds issued by companies are called corporate bonds, and they typically have higher interest rates than government bonds. U.S. Treasury bonds are issued by the United States government and have durations from 10 to 30 years. Medium duration bonds from the U.S. government are called Treasury notes and can range from duration from 1 year to 10 years. Treasury bills are bonds with less than 1 year of maturity. Collectively, these are called Treasuries and often have the lowest interest rate of bonds and are referred to sometimes as the risk-free interest rate. Municipal bonds are offered by states and municipalities or local governments. At least in the United States, one benefit of municipal bonds is that if you buy bonds within your municipality or state, they can be exempt from taxes. For this reason, given two bonds of the same credit quality and duration, if one is a municipal bond versus a corporate bond, the municipal bond will likely have a lower interest rate because of its tax advantages. There are a few variations in bond types that you should be aware of. One of these is zero coupon bonds that do not pay any interest. In lieu of this, they're instead issued at a discount, which will eventually converge to their face value upon maturity. The annualized yield you'd get from a zero coupon bond would actually be very similar to that of a coupon bond with similar credit quality and duration. Another type of unique bond is something called a convertible bond. These convertible bonds come with a call option that allows bondholders to convert their debt into stock if the stock price rises enough to make that an attractive option. In addition, some bonds are callable, meaning the issuer can call back the bond from bondholders if interest rates drop significantly. The benefits for a company of issuing a callable bond is that if they issue a bond at a higher interest rate environment and then interest rates drop, they can call back the bonds from that higher interest environment and instead then reissue a lower interest bond to investors. Investors, on the other hand, get the short end of the stick because if they initially got a higher interest rate, they could lose that and then would have to reinvest at a lower interest rate bond. Because of this, callable bonds typically have higher interest rates than non-callable bonds. Despite these variations, the majority of corporate bonds in the market today are standard bonds with no embedded options and that pay full face value upon maturity. If you're investing in bonds and holding all the way through till maturity, the return you're going to get on your investment is already predetermined. If you buy at face value and the bond issuer makes all their coupon payments and pays you back, then your return is going to be whatever the coupon rate is. In company financing, bondholders are always paid before stockholders, so there's less downside risk. Compare that to the almost unlimited upside potential you can get with stocks. Why would you want to hold bonds in the first place? Well, the reason is bonds can actually help diversify away some of the equity risk that comes with investing with stocks and overall improve the risk-adjusted returns of your portfolio. Many academic studies have shown that on a risk-adjusted basis, adding bonds to your portfolio actually improves your returns. A portfolio comprised of 100% stocks is taking a significant amount of risk, but only for a slightly better marginal return. Add to that the layer of human emotions that can come with such a stock-heavy portfolio, and you're bound to see some investor mistakes at the worst times. It's very hard to stay completely unemotional when your portfolio might fall 50%. However, having some bonds in your portfolio that are less affected by that stock crash can at least give you some cushion to reinvest at lower prices. Not only will this improve your portfolio returns, but it can help you stay a little more level-headed emotionally. To figure out which bonds are best for you, there are 4 main considerations that I'd like to think through. The first is the decision between bonds versus cash versus paying down your existing debt. Then there's the choice of investing in individual bonds versus a bond fund, which may have bonds from hundreds or thousands of companies. Furthermore, you'll need to make a decision on the credit quality you're willing to accept on your bonds, as well as the length of duration for your bonds. Those last two will have a significant impact on not only your interest rate of your bonds, but of your risk of your total bond portfolio. Regarding the first decision, if you've got money that you absolutely cannot lose, then that would be best put in cash. While certainly less risky than stocks, bonds still do have a certain amount of risk, especially if interest rates rise, which reduces the prices of current bonds. If you're unable to stomach that risk should that arrive, that money would have been better put just in cash. Another thing to consider before you start investing in bonds is to consider your personal debt situation. It doesn't really make much sense to be investing in a bond at 4% when you're paying 6% interest on your student loans. Doing that is effectively a guaranteed way to lose money. Especially if you have higher interest loans, it's likely you may not want to contribute to bonds at all because the returns you can get from paying down your existing debt are much higher than what's available out in the bond market. It'll be up for you to decide, but just remember that paying down your previously existing debt is a risk-free return, something that's not available in the market. Personally, from my perspective, I would see anything above a 4% interest rate on any debt you have as a very good investment option. Putting your cash towards that instead of a bond is likely going to do better for you in the long run than investing at a lower interest rate in bonds. If you have no debt and are comfortable with the risk of bonds, then you're ready for the next step, which is individual bonds or bond funds. I'm going to say off the bat that it's likely you'll want to go with a bond fund. Part of the reason for this is that the bond market is a lot less transparent than the stock market. With stocks, you can look up the ticker anytime during the trading day and see its price. However, once bonds are issued, they're traded on the secondary market directly between investors. Part of the reason these bonds are traded over the counter or OTC is because there are many more different types of bonds than there are stocks. For instance, a company might have 2 shares of common stock, Class A or Class B, while they may have 30 different types of bonds. Multiply that by the number of companies out there, and it makes it very difficult for all these bonds to be traded on a single exchange. This will make your job a little bit harder as an investor because you won't necessarily have the exact bond that you want. Add to this, individual bonds often trade in lots of 5,000 units, meaning that you need at least $5,000 before you can even purchase an individual bond. Now, for some of you, this might not be an issue, but for many of you, I'm guessing that $5,000 is more than you'd want to put in a single bond right now. To avoid this complexity and barriers to investment, you can simply invest in a bond ETF or a mutual fund for a relatively low fee that will invest in hundreds or thousands of bonds. These funds can further be divided up based on credit quality or duration, so you can pick exactly the bonds that you're really looking for. Regarding credit quality, you'll need to make a decision on your bonds whether or not you want to invest in higher quality companies or governments or lower quality companies and governments for a potentially higher yield. Personally, I would only invest in higher quality government or corporate bonds. Part of the reason for this is if you're already taking significant risk with your equities, then loading up on junk bonds or high yield bonds is really not adding much diversification in terms of that equity risk. This is because lower quality bonds, particularly junk bonds, can end up trading a lot more like stocks than like bonds. That's because there's more uncertainty with these companies about whether or not they will actually repay the full amount come maturity date. If the point of bonds is to diversify against this risk, I only want to make sure that my bonds are almost certain to pay out. For that reason, I'd stick to government bond or high quality corporate bonds. As for duration, it's a bit of a personal preference and what you think the future can hold. In general, the longer duration you have, the higher interest rate you'll get on that bond. That being said, you have to ask yourself if that difference in interest rate is worth the additional risk. Should interest rates rise further, the prices of longer duration bonds will fall much faster than those of shorter duration bonds. Shorter duration bonds, given that they're much closer to when they'll actually be paid out at full face value, don't tend to fluctuate that much with interest rates. Long-term bonds, however, which might not be paid out for 10, 20, or even 30 years, can see quite wild fluctuations in their price based on rising or falling interest rates. Given that interest rates are still near historical lows and the Federal Reserve has planned to increase interest rates in the future, I think it's more likely we'll see rising rates rather than falling rates in the future. For this reason, almost 100% of my bond holdings are short-term or short-duration bonds. You'll have to decide for yourself whether you think longer duration bonds are worth the risks, but be sure to keep those risks in mind. How much of your portfolio percent you keep in bonds is really a personal preference. Now, generally speaking, the greater percentage of bonds in your portfolio, the less volatility you'll see from stock equity moves. This means you'll see less downside during a crash, but your upside will also be limited. There's a lot of rule of thumb guidance about how much bonds you should have in your portfolio at different stages in your life. Some people say take your age and have that percentage in bonds. Some people say age minus 10, age minus 20. All these different rules can get a bit confusing. Ultimately though, the decision about how much bonds you should have in your portfolio comes less down to age and more to risk tolerance. Even if you're 20 years old and if your whole career ahead of you, you might be better off with more percentage in bonds if you have a lower risk tolerance. If you're new to investing, I suggest the guideline that Benjamin Graham laid out in The Intelligent Investor, and is also the guideline that I use myself. That is, when you're starting out, start out with 50% cash and 50% bond. Now this is overly simple, but it provides a great starting point for investors, and they can adjust that as time goes on. Now you can adjust this guideline as you see fit, but Benjamin Graham suggested that at any time, you never have less than 25% of your portfolio in bonds, and you never have more than 75% of your portfolio in bonds. While this may seem conservative to have always at least 25% in bonds, it would provide a fair amount of downside risk protection should you see a market crash. Ultimately, the choice is yours, but these should give you a few starting point ideas for how much you'd want to allocate to bonds. So in this part of the video, we're actually going to take a look at some of the specific bond funds that could potentially work for you as an investment. So for this, we'll actually be taking a look at some of Vanguard's bond ETFs or exchange traded funds, which are effectively just funds or collections of lots of individual bonds. Vanguard has a long history of providing some of the most cost-effective investment vehicles for investors. I personally use Vanguard myself, and I'll show you the bond fund that I'm invested in. So for this, we want to actually take a look at their full bond ETF lineup. Now, I'm currently looking at ETFs, but Vanguard also has mutual funds available that you can look at as well. If you're interested in that, all you need to do is go up here and click mutual funds. As you'll notice, compared to the 15 ETFs, there's 37 mutual funds here. So you can get a bit more variety in terms of specific flavors of bond funds. However, do note that for mutual funds, you would not be able to purchase these in like a Robinhood account. For those, you need to stick with ETFs. So the most popular and most common bond fund is actually the total bond market index. So that'll be this one down here, ticker symbol BND. If you want total exposure to the US bond market, this would probably be the fund for you. It has a rock bottom expense ratio of 0.05% and provides exposure to the entire US investment grade bond market. For each of Vanguard's bond funds, you can check the credit quality down below. In this case, all the bonds are rated BAA and above. So there's no high yield or junk bonds in this fund. It'll also show you the average maturity date of each of the bonds in the fund, as well as the average duration. In this case, duration is actually a technical term referring to the sensitivity of these bonds to changes in interest rate. So in this case, a duration of 6.1 years means that if interest rates were to rise, let's say 1%, the price of this bond fund would likely fall by around 6%. That gets back to what I was talking about earlier, which was the longer duration bond you have, the more sensitive you are going to be to changes in interest rate. So let's actually go back to the entire list and compare some of these head to head. So in this case, it's split up by Treasury Agency, which is effectively US government bonds, investment grade bonds, which is corporate bonds or bonds issued by companies, also a tax exempt bond, which is from municipalities. Now you can look at this list on your own time as well, but I'll just point out a few things. So let's say you're interested in a shorter duration bond because you're not interested in taking on a lot of interest rate risk with the longer duration bonds. So in that case, you could look at potentially the short-term corporate bond ETF. Actually, I'm going to make this a little bigger. So you got the short-term corporate bond ETF, which is yielding 3.38%. Now you can compare that to a similar short-term treasury ETF, which is government bonds, and notice that the yield is lower at 2.55. These have similar durations, but the difference in interest rate is due to the credit quality between these two funds. Basically, what the market is saying here is that it's more likely that we might see some defaults in the bonds in the portfolio of the short-term corporate bond ETF than we'd likely see from a default from the US government or Treasury. Similarly, if you look at funds which have similar credit quality, for instance, looking at all the investment grade funds as a group, you'll notice that the funds with longer durations, so in this case the long-term corporate bond ETF, has a higher yield than the intermediate or short-term bond ETF. This is the extra reward for taking on more risk with the longer duration bonds. In this case, the long-term corporate bond has an average effective maturity of 24 years compared to the Vanguard short-term corporate bond, which has an average effective maturity of 3 years. So you can either wait 3 years to get your money back, or you can wait 24 years. Personally, for me, I would much rather go with the short-term corporate bond ETF compared to the long-term at this point, just because you're getting an additional basically 1.2% in yield, but you have to have bonds that are 20 years longer. For me, it's a clear pick with the short-term. But for you, it might be different, so you'll have to decide whether it's worth the risk or not. Now for me, I'm actually not invested in a bond ETF specifically, but I'm actually invested in a money market fund. So a money market fund is almost like a cash or cash equivalent option. You can think about it as like an ultra short duration bond. In this case, almost my entire bond position is in the Vanguard Prime Money Market Fund. So this fund is currently yielding 2.06%, which is actually better than most online savings banks right now. But compared to the bond ETFs, which have seen price fluctuations, and a lot of this is due to changes in interest rate, the prime money market fund does not see those price fluctuations and only increases with the added interest that comes in. This is the right option for at least me right now, because as I'm waiting to invest this cash and as interest rates continue to rise, or at least that's my perception that they will, I'd rather have my money in an investment vehicle that doesn't actually decline if interest rates continue to rise. Now the difference between this, the 2.06%, and let's say like the long-term corporate bond is much more significant. Now that's basically 2.5%. So it's going to be up to you to decide the risk return trade-off. Personally, for me, I'm much more comfortable with this, but for you, you might be okay with the longer term risk. For me, I'm not. So going back to the bond ETFs, if you're having trouble deciding which one is maybe best for you, I would always err on the side of being more cautious than being more aggressive, at least at first. So in this case, if you're deciding between like a long-term and short-term corporate bond ETF, probably might want to start off with a short-term. Same could go if you're looking between government and corporate as well. I mean, the safest you can go would be short-term government bonds. So that'd be at least one place to start. I hope this gives you a good overview of what bonds are and the bond investment options that you have. I know this is a long video, so I really appreciate you guys making it to the end. If you haven't already, like and subscribe. There's a lot more educational content coming for you guys. So until then, thank you guys for watching, and I will see you in the next video.